We have just passed the halfway mark of the year, making this a good opportunity to pause and reflect on the developments that have shaped markets so far. In this episode, we'll be discussing some of the issues making headlines today and how they can influence the investment landscape and what lessons can be drawn from past market cycles. To help us make sense of these developments, I'm excited to be joined by Mr. Gerald Ambrose, who will be sharing his personal perspectives and experiences from a career spanning decades in fund management. Gerald Ambrose has spent most of his professional career in financial markets working across both the sell-side broking and buy-side investment management, and after 8 years of commission in His Majesty's Royal Navy, where his final posting was as a submarine navigator, he began his career in financial markets in London as a trainee. In 1989, he moved to Malaysia, giving him a front-row seat to the country's rise in global equity markets. He later returned to the United Kingdom before spending several years across key financial centers in Asia during a period marked by major market cycles, including the Asian financial crisis. He went on to hold senior roles in institutional sales and investment management before joining Aberdeen Asset Management, where he established its Malaysian office. Under his leadership, assets under management grew from approximately $50 million to around $6 billion by the time he retired in June 2024, after 19 years with the firm. Following his retirement, he was appointed as an independent non-executive director at Opus Asset Management. Having weathered everything from submarines to bull and bear markets, he is now enjoying a well-deserved retirement. Has he finally found calmer waters? Mr. Ambrose, welcome to Coffee Talk.
Thank you very much, Noel. Nice to be here.
So, within your decades of being in Malaysia, what's life like now, especially after retirement?
Well, it's been quite a long time. My wife constantly reminds me that I've been here for more than half my life, having arrived here in 1989. And the change, the dynamism of Malaysia is very different from the UK. Everything is different, actually. I think a lot of people in the West may view Singapore as the height of Asian exoticism, but in fact it's a bit like Essex at 35 degrees. Well, actually nowadays Essex in the UK is at about 35 degrees. But Malaysia is a country that I think rewards people making an effort. That if you try to learn the language, try to learn the culture, even if you're really bad at it, and my Bahasa Melayu is terrible, and you learn some of the adat, etc., it's very much appreciated, and people reward you for making that effort. So I'm a sort of Matsale Melayu bastard, I suppose, if that's not a rude word, in the sense that I've spent so much time here, more than half my life here, I'm sort of getting used to it. But I do remember most of my childhood, and I started off in a farm. I got a degree in Greek and Latin. I then joined the Royal Navy, ended up as a submariner, and then went into capital markets. So it's quite a varied existence. And my children now, having been born and brought up here, went to university in the UK. They went to international school here in Malaysia, but they went to university in the UK and they haven't come back. I keep on telling them that there are much more opportunities here, but maybe that will happen one day. But we don't want to go back to UK.
You have definitely seen a lot of changes, especially in the fund management industry, right?
Yes.
On the investor side, it's usually when they park their money with a fund management company, they usually don't get to see what goes on behind the scenes. All they see is usually their statements, whether they're actually making profits or loss. Could you actually give us a glimpse into what a typical day would look like for you as a fund manager, and what is some of the work that actually goes into managing investments?
Okay, sure. I mean, I'm not saying that the way I or Aberdeen manages funds is the only way of doing it. There are many ways of skinning a cat, but Aberdeen was what you call an active fund manager. Most of our clients were institutions. Most of those institutions were pension funds, and they were looking for a realized return of 6 or 7% minimum every year, plus capital appreciation, with as little risk as possible. And Aberdeen, from the very beginning, 50 years ago, was a bottom-up fundamental fund manager. So our job was to go out and visit companies, find out as much as we can about them. I think governance from the very beginning was a very important factor, but we really wanted to find a company that had competitive advantages in a sector that could see quite visible growth, with a balance sheet and cash flow that can fund its expansion. Most importantly, a transparent management, an honest management that if they had excess cash, paid it back to investors rather than sort of build a whole load of condos on the quiet or whatever. So that's our philosophy, really, that if you carry out bottom-up fund management, you buy companies that you're very familiar with at a valuation that you think is considerably below what the fair value was, and ideally to sell it at significantly above that value. Now, to achieve that, I'm afraid it's not like Wall Street or some trading floor with people stripy jackets sort of violently signaling each other and buying and selling and trading commodities, futures, etc. It was really more like a library. It was most of the time was spent preparing for, carrying out, and reporting on the companies that we visited, which produced. If you visit. How many companies are there? 900 plus in the KLSE or Bursa Malaysia. If you visit as many as you can, you bring out a list of companies that you think meet our quality and valuation requirements. And that's the sort of first building blocks of a portfolio. The routine in a day, I suppose, started at 8 o'clock with a team meeting. In which we discussed the news of the day and how that news might affect our portfolio of stocks. We would comment on any results that might have come out from the companies in our portfolio and adjust our forecasts, etc., accordingly. And talk through any company that we visited. And it's important, not to be won over or fall in love with the company. So we'd always have a devil's advocate to put the case against, rather than as well as the case for, really to give it a thorough inspection before we might make an investment decision. And I'm afraid, unlike Wall Street, etc., or the impression you might get from the Wolf of Wall Street, etc. We used to move at the speed of a striking slug, I always said. We'd take a long time before we made a decision. And when we made a decision, we would hope that we would build a small position in a company and gradually increase it. So most of a team of 5 or 6 equity fund managers would spend their time doing that. Then there were portfolio managers who would assess, what weight of the list in our buy list would go into the portfolio. Not much time was spent actually trading. Usually after the morning meeting at 8 o'clock, we might make some tweaks, or if we got more funding, we would decide where that money would go into portfolios. We'd put the orders on through increasingly, computerized, centralized systems, or digitalized, and then we'd get on with the routine of the day. So that was the basic routine. And then there were, because Aberdeen was a multinational fund manager, on Tuesdays, I remember we used to have a thing called the Global Emerging Market Weekly Investment Meeting, in which we looked a bit more macro. And on a Friday, we'd have a regional investment meeting in which we looked at the macro and individual stocks and the effect, how different sectors were faring in different economies that might have a bearing on the stocks you had in your Malaysian portfolio.
Yeah.
And then, of course, there are clients. You have to keep in close touch with them. You have to inform them if things are not going according to plan. Nobody likes surprises. We'd always have a quarterly review with each of our clients, and then our clients would invite us to attend various conferences they might have. And I, as the CEO, would play an active role in that liaison. I was really a salesman more than a fund manager, and left the actual day-to-day fund management to the excellent team I had.
Yeah, I mean, you actually hit the nail on the head, because I have this belief as well that CEOs for any company is actually the salesperson for the company. Just like the late Steve Jobs, for Apple, he had to sell the product to the world. He had to get the buy-in and all. And yes, I do agree on that point about the...
No, I think everything. Yeah. I mean, my brother got first-class honours in law at Cambridge University. He's the best lawyer you'd ever want if you were buying a house or in anything. But is he a salesman? No, he's not. He doesn't like any of that. So, he's done okay. He's got a little country practice. But the real, everybody has to be a salesman, whether you're an artist or a fund manager or Steve Jobs or who's the guy that always wears the leather jacket that's in charge of NVIDIA?
Jensen Huang.
Yeah, all that, I've tried the leather jacket, but it just didn't work.
I hope the audience watching this will understand a little bit better about where your money actually goes. It's not just fees and charges just disappearing into the ether. So yeah, thank you for sharing that.
Well, I'd love to say that we're overworked and underpaid. I suppose every profession says that, but certainly in the fund management industry, the wonderful thing about a technology is that because of digitalization, computerization, fees can be lower because you've bypassed a lot of the expenses. But lower fees and the costs for fund management have gone up significantly with compliance, legal requirements, and all the technology you might need. Yep. My personal view is quite often you have too much technology. Yep. It means that the poor fund manager is stuck in between. And if you see one strumming a guitar outside Bukit Bintang LRT, drop him a few cents.
Yeah, speaking about that, like you mentioned about the compliance and all this, like I read somewhere quite a while ago, the risk and potential issues with the rise of AI is the accountability. People can conveniently say, oh, it's not actually what I did, it's what the machine did. So I guess that's where you're coming from in terms of having even more compliance now, in tandem with all this technology.
I don't think you can blame the machine. I remember my time as a naval officer is that, if a stoker doesn't carry out the dips of the bilges and notice that the oil level is going up and the submarine sinks or the ship sinks, it's not the stoker that gets it in the neck, it's the commanding officer. You're responsible for everything. So I don't think you can really say, it was a computer, it wasn't our fault. But there's an increasing danger of that. And I am not an expert on AI, but I can see how, the aim for autonomy, or rather like that movie Terminator, the Skynet actually having its ability to make its own decision, is something you should be very wary of, and there has to be a human element.
Needless to say, you have witnessed several decades of development in the fund management industry, from the way investments were researched and managed in your early days to today's technology-driven environment.
Yeah.
How has that role of the fund manager changed? I know you touched a little bit on that, but let us explore further into this.
I think the role has barely changed at all. The objective remains the same, which is to do your utmost to achieve the targets of your client. And Aberdeen was, I think it's changed a little bit now, is more multi-asset and multidisciplinary, but we were really bottom-up active fund managers, and our aim was to visit as many companies as we can and find out those ones that have that moat or competitive advantage, are exposed to a sector that we could be wrong, but we see significant growth in the foreseeable future. And to make sure that management is honest and not telling you lies. And we looked closely at the balance sheet as well, to make sure that the cash flow was sufficient to fund that expansion and ideally to pay any excess cash to shareholders, and that the management understood what a shareholder was, and that the management had integrity, really. That's a key factor that is now a much more important factor than it was 30, 40 years when I started in this industry. But I mean, ESG, environment, social governance, I think the root of it all is G. If you have a manager or the executives have a moral code and understand that they have obligations to their shareholders, but now it's not just shareholders, it's the staff, it's the suppliers, it's the regulators, it's the country, it's the stakeholders. It's a lot more responsibility than they had, but they have to take that on board. And you read a lot of, hundreds of pages in massive annual reports about how much they care. A lot of it is not the truth. May have been cut and pasted, etc. So, it's AI can't tell you that. Fund management is part science, part art. And I think that the art is the more difficult part of the process.
So would you say that, to sum it up, like AI, all this high-tech computing power and stuff, this is just the next evolution and a step of a calculator. They allow us to do things more efficiently, faster, but there's still a lot of things like you have just shared. The human element still needs to be there.
Yes, the objectives remain the same. What your client tells you that they want to do. But the tool set you have to do it is huge, massive. Sometimes incredibly expensive. And a problem a lot of big companies have is that the executives of a board aren't really au fait with the IT, AI, and they might blow a lot of money on the wrong thing. That's happened on many occasions. So I used to find that we had too much software. There's too many bits of kit, and in the end, it becomes an end rather than a means to an end. And you can spend your whole time learning about some bit of kit you have for assessing your relationship with a client. And then once you've mastered that software, and everybody has to do it in order to have a unified, uniform way of applying it, then you'd have this bit of kit 2.0. So you're all sent to train again. So it can take up too much time. You don't. Beforehand, it used to be a struggle to get the information you need. Now the struggle is to basically winnow out the corn from the chaff. There's too much information. So that is something that is increasingly important in the fund management industry and probably many other industries.
So would you say, like, with this great power comes greater responsibility, where now people have access to more tools, more information, but it's even more crucial that people exercise better judgment on how to make use of these things and the results that they actually get from it.
There's only 24 hours in a day. Ideally, we need to, at Aberdeen, we used to, and I hope they still do, make sure that there is a work-life balance. You hear about all these Wall Street companies, Goldman Sachs, etc., having the grunts staying in sleeping bags overnight, bringing out prospectuses, etc., or doing some algorithmic calculation. I think you've got to be able to balance work and life so that you can have a career in something, and you've got to enjoy what you do. If you don't enjoy doing research and going through balance sheets, trying to find, related party transactions or areas of a balance sheet where things seem to be a little bit funny, then maybe a different career might suit you. So all the equipment that we had goes toward improving your service to the client. And if it takes up more time so that the service to the client is worse, then you're making a mistake.
Well said. So within that conversation, we actually, we were talking about the rise of technology and also the balance with the human elements of what needs to be done in order to access like judgment and how to actually best use of the tools that we have. Mm-hmm. So throughout your career, you have experienced major market events such as the Asian financial crisis, the global financial crisis, and the COVID pandemic. When faced with events that can significantly disrupt markets, how do fund managers balance the need to react quickly while avoiding emotional or short-term decisions?
It's difficult, and I got a few of them wrong. The less experience you have, the more difficult it is. I would say that the first one I encountered was when I was sent to Hong Kong by this stockbroker I worked for called First Pacific back in 1987. And I arrived there on the 1st of October 1987. And on October the 6th, it was called Black Monday, the markets just completely fell out of bed. And there didn't really seem to be any indication that this was going to happen. But what normally happens in markets is people get arrogant, they get blasé, they think that it's easy money, they follow tips and think it can't go wrong. We saw the same thing in the run up to the Asian financial crisis. So I suppose the real skill is to see that coming and not to get over your skis. I've never skied before, but I think it means that, don't get in a position at which you're going to go front over back, head over heels. So just to stick to your fundamental requirements. And there's so much noise going on. I would say this, that as an institutional fund manager, as a professional fund manager, it really, if you get it wrong, but everybody else, all your competitors get it wrong, you're okay. If you get it wrong and you get it wrong on your own, you're out. So quite often you see something developing, but your hands are tied to go against the tide. And I see that going on right now. I see all this concentration of money in a few individual, Magnificent Seven, hyperscalers, AI-related stocks. And I just think that there's an awful lot of hype there. So you had to be aware of that. But certainly that first October Black Monday, 1987 crisis, I didn't see coming. I don't think anybody did. The only person I know who saw it was a guy called Sir James Goldsmith. I don't know if you've ever heard of this guy. He was this very wealthy French Jewish magnate who owned many, many things through a company called Cavenham. And a week before the 6th of October, he sold everything, cashed out on everything. And I remember seeing on the news, I was in the UK at the time, and they said, "Why did you sell out?" And he said, "I don't know. I've been around for quite a long time and I don't have any means of measuring it, but I just feel things aren't right at the moment. Some people have a sixth sense." And he bailed out just in time. So there are investment geniuses, as we all know. So that one was a a liquidity problem back then. People had brought new derivative trading systems on board that meant computerized trading led to a 10% fall in shares, leading to all these computers tripping into selling. That still goes on. The Asian financial crisis was more of a solvency rather than a liquidity problem. We had 7 years of pretty powerful bull markets. For Malaysia, we were 26% of the MSCI all-country Asia-Pacific ex-Japan index. There weren't many investable markets back then. China, India, Vietnam, Korea, Taiwan were not investable. So Malaysia was a market that you had to have. You couldn't just say, I don't like it. I think Malaysia got a little bit too arrogant as the money poured in, whether you had the fundamentals or not. You get used to that and you make the assumption the money's always going to pour in. And I remember I was working for CIMB Securities at the time, and our chief economist was saying, "Don't worry, it's long-term capital. It's coming in to invest in our industry." But in fact, so-called industrial investment was in real estate, in trading stocks, borrowing from banks that weren't really looking at the risks. And it all went pop pretty quickly throughout Southeast Asia. I didn't see it coming. Many did. Many of the global strategists saw the Asian financial crisis coming. But it's just a question of whether you see it. And I'm probably going on a little bit here, but a lot of these strategists who did see it were removed from their companies because they were too bearish. Every broker, every fund manager likes prices to go up. Sometimes they don't, and they don't like to hear it.
while you were quite kind to say that a lot of people saw it, I think I would like to say that majority may not have seen it. Otherwise, it wouldn't have been called a crisis in the first place.
Yes. Yeah. Oh, a few did. But then you go to the global financial crisis. And I remember the Bank of England governor going to see the Queen, the late Queen Elizabeth II. And she said, look, with this terrible crisis, why didn't you any of you see it coming? And I think the central bank governor, Sir Mervyn Davies, said, well, I don't know, we just didn't see it coming. That's not really true. There were a lot of people who saw it coming. But if you're all in a boat and you jump out and you're the first one, you're in danger of losing your job. So you just stay in that boat. I think there's quite a lot of that still goes on. These things always repeat themselves. And maybe we're at a pretty high level of a crazy bull market at the moment, particularly in the West, I'd say.
The geopolitical issue du jour has once again highlighted how interconnected the world has become. A conflict or disruption thousands of miles away can eventually be felt closer to home, from energy prices and supply chains to cost of everyday items like our roti canai and teh tarik at the mamak. From a fund manager's perspective, how should investors interpret these developments and what should they be actually paying attention to?
Right. Certainly, the world has become more interconnected throughout my career. Yeah. And I think we might be at the point at which we're going to start to become more disconnected. You know, the world is going from globalized to more localized or diversified. The world is going from, logistics making everything's just-in-time delivery, so to make the maximum efficiency, to having just in case. You've got to have inventories of everything. And it's a very key thing to look at. In the case of, Malaysia, we might actually be beneficiaries of this trade war between China and the US. And it all started with, I think, the US being scared that China's developing too fast. Globalization has been of huge benefit to Chinese in terms of manufacturing at a competitive price and exporting it. The Americans decided that they weren't going to let the Chinese have some key elements of the components that they needed. And in order to get them, they would move to countries outside China. And in terms of the US as well, the US would have to locate out of China to a more neutral country. And Malaysia's been a huge beneficiary of that from our semiconductor and related industries related to the semiconductor. So you have to be aware of that. But all these things, I think, are driven by two factors, greed and fear. So you have to be very aware of that. I think it was Keynes who said that, a market can be irrational for a longer time than you can remain solvent. If you take a bearish position too early, you're going to lose assets under management and you're going to underperform. So you have to be very careful, and that's maybe where the art of fund management comes in, but we're at a really interesting time at the moment, certainly.
From what you've just shared, I think there is actually, wisdom and benefit for investors to actually rely on fund managers to handle their portfolio, as opposed to like people going directly into the stocks and shares. I mean, there are people out there who are more savvy and able to make quick decisions based on the markets, and there are those people who, like myself, we're very busy with our everyday lives, and we just do not have that time to commit to watching the markets and making a decision and all that. So again, benefits of fund managers in the industry.
Well, I would just, as a little addendum to that, say that nowadays you can put your hands in different types of fund managers. And it's because of the democratization of finance, and because technology has led fees to fall, you can give your order to a computer, i.e. an exchange-traded fund, which might buy every company in the Standard & Poor's 500 index, or maybe concentrate. You can get ETFs now that concentrate on just NVIDIA or just SK Hynix or Samsung. And you can then also get exposure to SK Hynix, Samsung, NVIDIA. On a geared basis, you have a 2 times, 3 times geared ETF that just is purely mainlining those stocks, and your performance will be fantastic on the upside. But there's a downside to all this. Computers, there's no price discovery in a computer. If you give an order to an ETF, it can give you a selection of companies that are the blue chips in any index. And in the case of the US, a lot of them tend to be the biggest, highest growth indices. But these computers don't look at the price, the quality of management, the honesty of the company, the potential growth. All they look at is free float and size and liquidity. Yep. You tell a computer, you want to buy an ETF, the computer will just hit the offer. Yep. And then we've got to the stage in the US, I think, that a lot of ordinary people have a sort of tax-free investment system called the 401k, and they dedicate X% of their wages to go straight into the S&P 500 401k. And it's just driven prices up to very high levels. If something untoward happens, say in AI, and I don't know whether it will or not, then some of these people who have made a fortune, they're sitting on an absolute fortune, irrespective of their jobs, they can retire tomorrow. If they all see things are not going the way they planned and these ETFs are not working as they planned, they will all get out and try and get out through the door at the same time. These computers won't say, oh, look, I'll wait for a better price. As soon as they're told to sell, they will hit the bid and things just go what Soros calls reflexivity. It'll all come back tumbling down again. Mm-hmm. Whereas if you keep in perspective, from my point of view, the fundamentals of the company, its valuation, what you think a fair value is, and buy it when it's ridiculously undervalued, ideally sell it when it's ridiculously overvalued. Over the long cycle, like Warren Buffett, Berkshire Hathaway, it works out. But there are times when you are guaranteed to underperform a market when it's in sort of melt-up mode.
Yeah, so the average person on the street, I would like to say, wouldn't have these, combined extensive years of experience and exposures to what goes on.
Nor my good looks. I mean, I'm blessed with so many things.
As you can see, there's a recurring theme here. I'm always bringing it back up to, the part about the human element, the importance of the human element in the backdrop of all the rise of AI and technology. Yes. That, it is still very much important. We can't outsource, everything like our judgment and evaluation of things.
Yeah, I would just say one key thing I think that people have forgotten, and that is equity markets, bond markets, every market, property market, goods markets, from BC times, from thousands of years ago. It's basically been a system of people who are maybe older and have accumulated wealth, but are not in touch with the world, don't want to spend a lot of time working out what the best investment is, finding out from young entrepreneurs who are in touch with the world what's needed, giving them the money and making more money from it, okay? But the ultimate aim of a market is to produce products that make a society a better place, give you a greater variety in a society, and give you things that are better. Now, part of that market competition is there have to be losers. I can't remember what the name of the guy was. He was Borman, I think. He was a astronaut and then became a scientist at NASA. But he said basically, a capitalism without bankruptcy is like Christianity or Islam without hell. You have to have that disciplining factor. So I think people have to understand that markets are there to make society a better place for the benefit of everybody, and it is not to make a fast buck. Of course, there has to be a financial incentive for the whole thing to work, but you can't put your money in without putting proper thought into it. And there are fund managers who do that. There are other fund managers who don't do that.
Artificial intelligence, semiconductors and data centers have become some sort of the biggest investment themes in recent years. From your perspective, do you think this represents a genuine long-term transformation in the economy? Or are we also seeing elements of market enthusiasm and hype? Like currently it's still hot. Is there like is it going to be a long-term thing? Or is it, do you foresee it's going to be people will start to realize, maybe it's not as great as a great thing since sliced bread kind of thing?
I don't really like sliced bread very much. I'd rather slice it myself. But actually, I think it's both. I think it is a genuine long-term transformation. It's not just me thinking that. There are people I know who are experts all over the world who genuinely believe that this is a revolutionary development that is going to change the world, for better or for worse, I don't know. But also, I think there's an awful lot of exuberance and a lot of hype there at the moment. And we're at the sort of real riptide at the moment of excitement. I think the signs of it are, Elon Musk and SpaceX, Altman of OpenAI, Anthropic, all deciding to raise funds and to go for the public markets. Okay. Now, a lot of these companies that are involved in AI, the hyperscalers, they have huge cash flows and they have massive margins, up to 85%. They're using almost all of this to put it into AI. Now, I don't know, you've got companies like Amazon, who's, the trading center or the platform of the world. You've got Meta, which is the social media platform of the world. You've got Alphabet, which is the search engine that provides us huge cash flow. You've got Apple, the mobile phone producer. You've got Oracle, which is, the king of software. They're all using their money to invest in AI. It's not just a little bit. It's $750 billion this year. I think it was, I can't remember what the authority that brought this number out, but they estimate that $6 trillion will be spent by these hyperscalers on preparing and building AI between now and 2030. But they've run out of cash flow now. A lot of these companies, particularly Oracle, is having to borrow money to do it. There are signs that things are getting a little bit tired. You've got all these people that what they call circular finance. They're all taking stakes in each other. Yeah. And if you look at the first quarter results of a lot of these companies, the biggest growth in their profit was their equity investment in each other. Okay, that's a little bit incestuous and a little bit dangerous. So there's that problem. And they're all specialists and experts and have huge margins in different things. They're all chasing one holy grail now, which is mastery of AI. And I don't think they can all win. It's possible if you look at previous records like, or revolutionary developments like railways, like the steam engine, like the internet back in the late 90s. Possible that none of them will be winners. They might overinvest and set up the fantastic infrastructure like Global Crossing did back in the late 90s. But they themselves might go bust because they're the ones that are investing all this money in being the front runners and the pioneers of new technology. I think you're seeing now people copycatting and using their expertise to ride that. And in fact, some people are saying the Chinese, the AI players, they have largely small language models as opposed to the likes of OpenAI and Anthropic's large language models. Large language models are rather like the sort of Ferraris of the business. You have to pay a lot of money to get it, and it's like a fortress. But the open language models, the small language models that are provided by people like DeepSeek, allow you to adapt and use other people's expertise, your own software people, to adapt that particular piece of AI for your particular business. So we don't know yet how these players will be able to monetize what they're doing. But if it's another $6 trillion between now and the end of this decade, that's an awful lot of money they have to make back. I think some of them won't do it. So don't get completely excited about the companies that are going crazy at the moment. But I think maybe the whole concept of AI may be revolutionary, yes, but we don't know how yet they're going to make money out of it. Rather like when the steam engine was invented, I don't think when that happened, they realized it would lead to mass manufacturing and, industrial manufacturing of goods for the world, etc. When it first started, you're not aware of the potential of it.
I guess we are still pretty much like at either the beginning or just the beginning or the middle of the rise of all these technologies. Like you've mentioned, we still don't know how it's actually going to pan out yet. The horizon is still pretty much quite a distance away.
Yeah, I mean, if I had, a huge amount of money, I wouldn't completely ignore, the hyperscalers, the Magnificent Seven or Samsung and Hynix, but they have had the hell of a run. And if you're looking at Samsung and Hynix, for example, there's so much money going into them, and these 2 times geared ETFs, 3 times geared ETFs, that all these computers that are playing these geared ETFs have to play the futures market, which requires even more money. There's so much money that actually, if you're an individual, the profitability walks out the door. It's no longer there. It takes up too much money. Mm-hmm. So I think you want to be a little bit careful, and maybe a lot of the other tools and bits of equipment that's needed for AI might be a better way of looking at it, even as indirect as electricity and water.
Yep.
You know, here in Malaysia, we don't really, I don't think yet have the transmission system and ability to adapt to the huge acceleration in data centers that are coming up. Even at the end of my road, there's this massive Lend-Lease built data center. The people are now getting worried. It looks like a hotel. It looks a lot nicer than the hotels in PJ, actually. But it's apparently going to make quite a lot of noise. It's going to obviously create a lot of heat. And where I live, we're having power cuts and water cuts all the time. So I don't know how that's going to work out. Yeah. So there will be quite a lot of pain before we find the answer.
Exactly. So this actually segues very well into my next question. Like you've rightfully pointed out, the growth of AI and data centers has also brought attention to, you know, their heavy resources requirements, and particularly in terms of energy, water, and land, as you've pointed out. You know, given the increasing focus on sustainability as well, you know, and the E in ESG, the environment part, how should investors think about this apparent tension, or, you know, I don't know what's the word, dichotomy, you know, between technological progress and environmental considerations? Can these two objectives actually, you know, realistically, can they coexist?
Well, I think they can, but it involves even more investment. And sometimes the successful players are the ones that are really forced by shortage of resources to be more efficient. I think the Chinese, you know, they import most of their fossil fuels. And I don't know, 20 years ago, or maybe pre-Joe Biden, the Americans made it quite clear that they're worried about the growth of China, and they're going to restrict access to anything they can in terms of fossil fuel, in terms of high sensitivity, or high microchips that have defense capability or security capability from them. So the Chinese decided back then that they better prepare for this. So they started building up inventories of everything they needed, and they started to invest heavily in renewable energy. And lo and behold, they've now got to the stage where if they were not able to import any fossil fuels, they can run their electricity at 60% on wind, solar, nuclear, and geothermal and hydropower, so renewable energy. And they have been forced by circumstances to improve their technology in transmitting and storage of these things. But the key thing about renewable energy is that it goes, if the wind stops, if the clouds cover happens, and if the water levels go down, then you have to have standby sources of power, such as nuclear, such as coal now. You know, you're starting to see exports of coal from Indonesia now, as everybody realizes that they can't have all their eggs in one basket. Even Tenaga started to buy coal, not just from Indonesia, but from maybe 3 or 4 different sources, because the way the world is going is it's sort of anti-globalization. You can't rely on any one source because the risk of it being cut off is quite significant. So I think the Chinese have managed to master cheap electricity and abundant electricity and renewable electricity. That's, I think, the holy grail that everybody has. Malaysia actually has relatively cheap electricity, and we have, you know, God has given Malaysia natural gas, which we're making much more use of now, but we still have to import LNG from other countries and have gasification plants, etc. We have to make more use of solar, etc., because Malaysia's other cost bases are relatively lower than other countries, which is why so many data centers are being set up here rather than in, I don't know, Singapore or Indonesia or even Thailand. So it is a battle, and we have to be aware that there is a environmental and social impact. As I say, it all roots from governance, and I just want to make one point about governance as well, and about the worry about ESG is our future generations might be affected badly by what we're doing today. But also in terms of finance, each country, particularly in the West, have become more and more geared, borrowing more and more money. And that is basically using future to spend now. So, the next generation, you won't believe it, I'm 67 years old. I think, well, it's not my problem, it's the next generation. But I just think we have to be more responsible to make sure that we have a planet and a balance sheet that our offspring is able to grow from. So that's a real risk, as you say.
But you've also actually summarized very well the human behavior generally speaking, where for human behavior, when something is far away, like 10 years, 20 years, 30 years down the road, it becomes an abstract. And, then it's harder for them to perceive the urgency to actually address those things. It's like, it's a future me problem, that kind of thing.
Human nature. I think we're getting closer to it. But I seem to remember there's a guy called Groucho Marx. He was a comedian, and he once said, after all, what have the future generations ever done for us? You can say that. But in fact, my generation, the baby boomers, seem to be in a position at the moment of the largest share of wealth. A lot of it in real estate, a lot of it in equities, a lot of it gained through 401ks, through ETFs, etc. And it's that transition or the passing of that wealth to the next generation that we're a bit kadukut about at the moment. I think it may come very quickly. I remember one guy said, Luke Groman his name, he said, the best answer to the world's fiscal problems is if every baby boomer died tomorrow. Because all these baby boomers, they're just saving money. They're not spending it. If you suddenly die and you bequeath it to your children, they're going to spend it. They need the money. You get economic growth when people spend money. Mm-hmm. So that might be the answer. Not that I'm asking you to kill me or anything like that.
After decades of navigating markets across different countries and through many cycles, what is one investment lesson or principle that has remained constant throughout your career? And, one that you believe investors should also keep in mind today?
Well, I think it's one that I've mentioned before that has been forgotten. And that is that markets, fund management, brokers, the whole thing is meant to be of benefit to society. Mm-hmm. In order to be of benefit to society, there has to be the possibility of people making good money from it after carrying out correct analysis and investing in the right things. And there is a downside, and that is if you invest in the wrong things, you lose your money. If you have a business, a listed company that makes the wrong investment decisions, your share price is going to fall, and the money will go to the companies that are in a better position. So I think it's the social benefit of markets that people forget. And if you just want to rip the face off a market, double your money in a week, I think there's a danger there. You could do that, but the downside is significant. And I still think in Malaysia, even in the unit trust industry, actually, there is this concept amongst investors that I want something that I buy on Monday that will have doubled by the following Monday. That happens very rarely. It does happen, and we're seeing it go on at the moment. But the sensible way is the Warren Buffett way, really, I think, and that's to look at the long term by sensibly run companies for the long term.
Mr. Ambrose, thank you very much for taking the time to join us today and for sharing your personal perspective from your many years in fund management.
You're welcome.
We hope this conversation has helped our viewers look beyond the headlines, appreciate the broader context behind world events and market developments, and approach the investment landscape with a more informed perspective. For more Coffee Talk, make sure to hit the like and subscribe on FIMM's YouTube channel so you won't miss future content. See you in the next episode.